This is week 6 of documenting my journey learning how to trade algorithmically. This week, I focused on optimizing my strategy to pass prop firms. This week, we're going to go over last week's goals, sentiment, alpha versus beta, a potential quant project I may work on, my revised and optimized strategy, takeaways from my readings this week, and then next week's goals. Last week's goals were to see if I can refine the current prop firm strategy without backfitting. This one I sort of completed. I definitely did refine it and optimize it, but there was some backfitting involved. Next, explain alpha and beta. Did that, we'll get to that in a second. Plan and propose quant project, completed that. And then take action wholesaling, sorta completed that. Sentiment from this week, now it's summer. I thought I would have way more time. Turns out that is not the case. Still very busy. Luckily, this is an exciting project, so I'm happy to make time for it. Beta is used to determine the volatility of an asset in relation to a benchmark, usually the S&P 500. The overall market has a beta of 1. And so an asset with a beta of 0.6 would mean that it is less volatile than the market on average. And a beta of 1.5 would be more volatile than the market on average. Now that volatility is in correlation with the market. So let's look at an example to better illustrate this. If a given asset has a beta of 1.5, then let's say over a given period of time, the market returned 10%. The beta of that asset is 1.5. The expected returns of that asset over that period would be 15%. It is in correlation with the overall market. In this case, it is more volatile than the overall market by a factor of 1.5. So, like demonstrated, if the overall market goes up 10%, this asset would go up 15%. Alpha is a measure of how much an asset beats risk-adjusted expectations. So let's revisit the example from the last slide and try to figure out the alpha. So we said the beta was 1.5. And then the returns of the market over a period were 10%. And so the expected returns of this asset was 15%. And so that is the expected. Now we look at what was the actual performance. This is how you determine alpha. It's the difference between the actual and the expected returns. And so we had actual returns of 18% when the expected, given the beta, was 15%. The alpha that was generated with that asset and strategy over the given period of time was 3%. Now that example that we just looked at, we essentially illustrated the relationship between alpha and beta, which is more commonly known as CAPM expected returns model and CAPM regression, often a linear regression. So these two formulas that we see here are essentially what we derived with the examples on the previous slides. The key thing to note here is in a perfect market, alpha would be 0. Every asset would be perfectly priced. You couldn't find inefficiencies and you couldn't generate alpha. Alpha represents a gap. That is the inefficiency, is that it is a gap between expected price and actual price. I like this wording down here in the bottom right to illustrate alpha and beta. Beta, how much your portfolio or an asset or strategy moves with the market. And then alpha, how much you beat or missed that expected returns. Then before we move on to the next slide, I do just want to preface, I looked all this up this week. I am in no way an expert, and I'm explaining it to better my own understanding. All right, plan and propose a quant project. This was one of the goals for this week, doing something project-based where there is a final outcome and I could work with someone on it. So there's a couple different directions you could go. The direction that I ultimately did not want to go is building a machine learning algorithm neural network. Also, just do not have the knowledge to be able to do that. So the direction I ultimately chose to go is building an algorithmic trading strategy for a simulated trading competition. So why do I want to do this? Well, besides learning, it does look good on the resume for club applications. The competition side of it holds me accountable and also makes it more official. And then timeline wise, I found some good competitions that line up perfectly, so that I can be completing this project before I head off to college in the fall. Next up, taking action on learning about real estate. So there wasn't actually much action taken. All I did was I found a guy who I see often at work. He comes in a lot. He has seen me on the job, and I guess he admires my work ethic. He is in real estate law, so all of his clients are big in real estate. I have not seen him since writing this down, but when I do see him, I will connect with him. Hopefully he can put me in contact with some of his clients. I can speak with them and learn a lot more about the industry. This was the framework I built a couple weeks ago. We are, again, down here now in this section, executing, not in the real world, but executing with the back tests and testing in multi-charts. I do need to add another layer in here, and that is optimizing, because I'm not just coding the strategies and testing them once, coding them, testing them, looking at the different variables, changing them, testing again, iterating and optimizing, trying not to backfit too much to find the best version of the strategy. That's really what I focused on this week. So this is stuff for last week, but I was optimizing the same strategy as last week, so just going to go through it super quick. This was the paper where I got the research hypothesis. The inefficiency that it aims to exploit is the volatility risk premium. These are the general rules and parameters of the prop firm that I chose to put into the strategy as the given parameters for the back tests. Created a prompt in Copilot for Gemini to write the code. Had Gemini write the code with access to the research paper. Optimized and tweaked that code back in Copilot. Put that code into multi-charts. Back-tested the strategy over 6 months. And it generated about $6,400 with a Sharpe ratio of 0.12. This is the equity curve of the strategy versus the equity curve of buying and holding. So this week, I used grid searches to optimize the different variables in the strategy for the most net profit. So for example, the variable RV look back was at, say, 20 before, but now we're testing that with a bunch of different levels. So we have 20, 30, 40, 50. Then the other variable we varied momentum look back. And so that before was also, I think, at 20. But now we have different levels that we're testing. 20, 30, 40, 50. And these are fake numbers, but they all generate a different result. And so if we do 40 for RV look back and then 30 for momentum look back, that is going to give us a certain net profit over that time period. If we try 30 for RV look back and 50 for momentum look back, that is going to give us a different net profit over that time. And I initially started with varying the 3 different variables. So RV look back, VRP threshold, and momentum look back. And so that creates a quite expansive grid, and we tested out all the different combinations. It was an exhaustive grid search to try to find the combination or combinations that produce the maximal net profit. As we can see here, the goal was maximum net profit, and then the combinations that I ended up testing was 637 for this initial grid search. However, what I realized when looking at the results of the optimization was that the only variable that seemed to change the net profit was the momentum lookback. So although the key variable was supposed to be this VRP threshold, it ended up being the momentum lookback variable that caused all the variation in net profit. So I then reran the optimization, only varying momentum lookback, and had it vary in a much wider range, 0 through 140, with steps being only 1 unit. So 141 steps, because you have 0 as 1 step, and then 1 is the second step. Again, I ran an exhaustive grid search because there was only 141 combinations. If there is more than 1,000, then I've heard it's recommended to not use an exhaustive grid search and to instead use a genetic one. So what did I find? Again, I'm looking at the net profit, so here in green, and we could see a couple places where that peaked, and this was on the first optimization. So we can see the range here was only 20 to 80, but for example, it peaked at 20 and then peaked again at 40. So again, this would be backfitting, so I don't want to do this too much, but hypothetically could run this optimization, look at this data, go back to the study editor, edit my code, and then just set momentum lookback to 40 in the code, and iterate and keep changing variables and finding the best combinations and optimizing the strategy that way. That is the entire point of this optimization process. Now here we can see that momentum lookback was the only variable that caused any variation in net profit. When I look at the 3D graph with RV lookback plotted and VRP threshold plotted, we can see that neither of those does it affect at all the net profit. This is essentially a 2D graph. It is just completely flat on these planes. So this is the 2D graph when I reran the optimization with only varying the momentum lookback variable. As we can see, much larger range. We have 0 to 140 and much smaller steps. And then what I'm looking for here is robust areas, and that's how we aim to avoid backfitting. So, for example, the highest gross profit was either here or here, but it is a spike. It's over this time period. If you choose this exact input for that variable, you get a very high net profit. But that's chance. That's not robust. If you were to run it over a different time interval, you would likely get a very different result. Now, what we can see is that this range, likely, if you ran it over a bunch of different time frames, probably wouldn't give you a good result on any of them. Because in this whole range, the net profit is pretty low, sitting around that 6,000 mark. The range that appeared most robust to me is over here in this sort of 108 to 114 range. We seem to have the most iterations with a high net profit. We can see this again here. So a lot of them were ending up around this 6,000, 5,000 range for the net profit. But then if we look at 108 down to 115, we're looking at 85 all the way up to 173 and 150. There is one with 18,000, but again, I mean, that's still 3 times higher than over in this lower range. So this range right here seems to be the most robust range for the input of the momentum look back variable, which is the variable that causes change, variance in the output being net profit for this given strategy over this given time period. So, like I mentioned, go back to the study editor, input one of the values in the robust range, backtest again, look at the results. Here we can see, as we saw on the previous chart, net profit 173. Key here, the adjusted net profit is also profitable. Last time that was not profitable. So the hypothetical net profit was profitable, but in the real world, if you ran the strategy, you would lose money. After the optimization, with a little bit, maybe a lot of bit of backfitting to the given time period, we ended up with a strategy that not only generates a net profit, but also generates an adjusted net profit. Given that this strategy has to be within the parameters of a prop firm, that's how it was coded, with the max day drawdowns, starting capital, different limitations, resets if you blow the account. These metrics, both being positive, are a huge win and a huge proof of concept. Even if they come from backfitting, I'm still very excited about that. Okay, so now let's compare the old versus new strategy. The key thing I'm looking at here is the Sharpe ratio, and the Sharpe ratio on the past one, 0.12, Sharpe ratio on the new one, 0.56. The Sharpe ratio on the market overall is supposedly around 0.3. So the last one performed worse than the market. This one performs better than the market. Huge win, same strategy, just optimized through iterating the inputs of the different variables. This just about made my day, comparing the equity curves of a buy and hold strategy versus the optimized strategy that we've been going over. As we can see, same starting equity, 50,000, 50,000. Buy and hold, yes, does go up over the period of time. However, it goes up about 40,000. Then the strategy, which, yes, I do need to caveat, is backfitted. A little bit, hopefully not too much though. The new strategy goes up about 170,000. We looked at it, and so that is a huge win for me to see that even the backfitting strategy is drastically outperforming the market over this period. Something else interesting to note is the nature of this new strategy, given that it's within the parameters of a prop firm, is the resets. So you'll notice this strategy on the right, it starts at 50,000 and it can't really go much below that. We see at most it goes to, maybe that's like 48 or 49, because if you draw down below that, your max drawdown in a prop firm, you blow the account and you have to reset. Now, what I don't think this factors in is the cost of then buying a new account every time you blow it. I think I should be able to add that in later in maybe commissions or slippage. I think there should be a way to add in the expense of buying a new account when you hypothetically blow one. But it is just interesting to note it can't really drop below this 50,000 level, because then the account would be blown. So that was the new strategy. Very excited. Now moving on to the takeaways from the reading. Still, everything I'm hearing, power and infrastructure for AI is huge. However, since I'm hearing that a lot, that means all the hype is there. Don't buy the hype, buy the fear. Maybe I should not be overly invested in that if it's all I'm hearing. Another thing I've taken away, this wasn't even from my reading, but just from conversations with people, I am neglecting international markets too much. I was before neglecting them completely. I then moved about 30% of my retirement account to international funds, but I think I want to bump that up even more to around 40%, just to hedge American markets. A lot of these American-based AI companies, everyone says we're on the brink of a bubble. It seems like there's really no reason to not be more international. Then I don't know what this means, but it seems weird. Everyone is saying markets shouldn't be up. Given the global situation right now with all the conflict, markets should not be up, but they keep climbing. Why are they? What does this mean? Well, what people say it means is a bubble. Is that true? If so, how should I act going forward? Not sure. And then also, I wonder what the future of crypto looks like. I haven't really heard much about it recently. Maybe since there's not hype there, maybe that means I buy more. That is a principle that has seemed to work. Next week's goals, I want to create an entirely new strategy, not just optimize the past one that I've been doing, but create a new one that is meant for the actual asset that I use it on. This past strategy was meant for equities, and I used it on futures. Still kind of worked, but I do want to create a new strategy that is supposed to be used on the assets I'm using it on, and then create a 3D model with that tends to be better to find those robust areas that I'm searching for to avoid backfitting. Next, this is what I've been wanting to do for a while. I haven't really got around to it. 3 different types of Monte Carlo simulations. I want to figure out how to use those to predict future outcomes, because I have, in not much depth, gone through the different stages of backtesting. Creating a strategy, backtest it, vary the inputs, optimize it, backtest it again. And then I can just keep doing that cycle. But I want to be able to test it forward, not necessarily in live markets. Maybe in live markets at some point I will need to do that, even with fake money, but in hypothetical future markets. That is what I want to be able to do with Monte Carlo simulations. Goal for next week, figure out how to do that. Then lastly, I just used multi-charts and TopStep as names, but more simply put, how do I connect the code I have for a strategy in Power language, Pascal, Python, whatever language, to executing in a prop firm? I know some prop firms offer it. Which ones? How so? What languages? Goal for next week, figure out the lay of the land with that relationship between algorithmic trading and prop firms. Then, as always, continue reading 15 minutes a day, financial articles, financial statements, learning about the world of finance. That's it for today. Lastly, you gotta know this is purely a journal. It is not meant to be educational. It is not meant to be advice, and I am in no way an expert.